Trading. It can be a lucrative endeavor with potentially high returns, but most people will find trading to be challenging, with lots of mistakes that you can make on your journey to success. But by recognizing these mistakes and having plans to address them, you can increase your chances of surviving and thriving in the markets over the long term. The first mistake is not trading with a plan. A trading plan outlines your goals, risk tolerance, and your strategy. Trading without a plan leads to impulsive, inconsistent decision-making based on emotions rather than a thoughtful strategy. It makes you more susceptible to fear and greed, feelings that you will inevitably face when watching the markets. A plan provides a structured framework that helps you stick to predefined rules and make objective, unemotional decisions. Your trading plan should specify your entry and exit criteria for each trade. It quite literally needs to be a set of predetermined rules that specify when and how you will enter and exit trades. A trading plan should also include a review process that enables you to evaluate your performance and learn from mistakes. Without a review process, you're likely to repeat mistakes without a solid approach to self-improvement, which highlights our next mistake, not keeping a trade journal. The level of detail can vary based on personal preference and commitment, but at minimum, a trade journal is where you record all trade entries and exits. This allows you to review whether you've been sticking to your trading plan. Better yet, for each record, include a small note on the reason for which you took a trade, as well as the criteria for taking profit or stop losses. This makes it even easier to keep yourself accountable to your trading plan in real time. Keeping a consistent record will also enable you to evaluate the quality of your trades over time. You can record your trade down onto a spreadsheet, note-taking software, or on a journaling software such as CoinMarketManager. When evaluating past trades, you should be evaluating trade quality based on your execution process rather than its outcomes. Good trades are trades that are executed according to plan, based on the predefined rules set in the trading plan. Bad trades are simply trades executed outside of the predefined rules and trades we don't have business taking in the first place. Now, while it can be tempting to enter a trade due to some expectation or hope that the market might do something in the future, taking trades that are outside of our plan introduces subjectivity, making it inconsistent and difficult to manage. By focusing on taking good trades that follow the plan, you eliminate bad trades that might be taken out of subjective thinking. But of course, don't just stick to a bad plan. If you've been consistent with your plan over some time and notice consistent losses, it's time to review and make adjustments to it or assess if it's right for current market conditions. Backtesting can be your friend here. This video is brought to you by Sonic Labs. They're proudly launching round 2 of their meme season meme coin competition with 750k FTM tokens up for grabs. The first round saw 500k worth of liquid staked FTM tokens awarded to thousands of winners. Round 2 just launched on July 22nd and runs till September 5th and will be based on a brand new scoring formula, rewards distribution, and eligibility criteria. For this round, 90% of the prize pool will go to the top 500 holders of each winning meme coin and 10% to the teams. On top of that, even providing liquidity for eligible meme coins will count you as a holder and a participant in the competition. To sweeten things even more, Rabby users will get free gas for their first 10 transactions on leading dexes like Beethoven X, Spooky Swap, WeGo Swap, and more. It's super simple to join. First, set up any Phantom compatible wallet like Rabby or MetaMask. Visit the Meme Seasons leaderboard to see participating meme coins that are eligible for trading. Pick your favorite and potentially earn a prize for holding them or providing liquidity with them. For fellow traders and agents who are interested, apply now on their website. Full entry rules and further details from their blog posts will be linked in the description below. Another common mistake that traders make is overtrading. The fast-paced 24/7 nature of crypto markets can give the allure that there is always a need to be in the markets, but that is not true. Successful traders are those that are patient and wait for high-quality setups to show themselves in the market. To new traders, it might seem that the more trades they take, the more money that they would make. However, they will probably find out that the more frequently they trade, the more likely they're in fact taking low-quality trade setups. As a result, overtrading generally has a negative effect on profits, where an increased amount of losing trades dilute the impact of successful trades. Besides, overtrading leads to poor trade execution, and traders often spread themselves too thin when attempting to manage too many positions at once. This leads to exhaustion and burnout and can increase chances of making mistakes. The next mistake, trading your P&L. Okay, P&L stands for profit and loss, which is the amount of unrealized profits or loss in someone's account balance. Trading the P&L refers to traders that make trading decisions, such as exiting trades, choosing position size, or entering trades not based on the chart or what price action shows, but instead based on what you think affects your P&L. This is a no-no. One example of how this manifests is when traders in a losing position either add to the loss or widen the stop loss while hoping to exit their position at break even. At this point, the trader is only focused on the money that he doesn't want to lose and is not making an objective decision based on the chart or price action. Another example is a trader who is profiting from a winning trade, then suddenly sees a retracement and fears his unrealized profits may vanish. Finding good trade entries is only part of the challenge. You will also need to stay in profitable trades long enough for it to reach your preset take profit levels. If you find yourself struggling with trading the P&L, do your best to separate the charting process from trade executions. You can start by tweaking your settings and hiding the P&L from your trading or charting platforms as much as possible. Again, have a clear plan when entering trades. This means knowing where your stop losses and take profits need to be before even entering a trade. Once you've taken a trade, simply sit back and let it play out. Trading the P&L is always a sign of fixation over money. If you find yourself focusing on money too much when trading, consider reducing your trade size. Another mistake is not managing one's risk when trading, leading to outsized losses. Large losses can damage your progress and confidence, and recovering from them mentally can be very time-consuming. Proper risk management helps you survive through drawdowns and minimize losses. Based on their predetermined trading plan, traders can easily avoid this mistake by setting appropriate stop losses and take profits that consider current market conditions. It also helps to define your risk tolerance by finding out how much capital you're truly comfortable losing on a single trade. Sometimes you think you're okay with losing a certain amount on a trade, but if it turns against you, suddenly you find yourself overly anxious. Now, in this case, you should reduce your trade size. With that information, place stop loss orders that reflect your risk tolerance. It's generally wise to start with smaller positions until you gain experience and confidence in your trades, where you can then increase your position size gradually. Now, perhaps the most self-destructive mistake is revenge trading. Trading can be frustrating at times, especially when dealing with losses or losing streaks, but taking trades impulsively out of frustration and anger can be very damaging to your trading progress. Rather than following your well thought out strategy, making trades from irrational decision making, such as trying to recoup losses, can very quickly result in further losses. To combat the urge to revenge trade, accept losses as part of trading and focus on learning from losses to improve your strategy. Give yourself time to recover and clear your head after a loss. Perhaps leave the desk and take a walk. As the meme goes, go touch grass. Vouch to sticking to your trading plan and risk management strategies even after experiencing a loss. By developing techniques and protocols to manage emotions, you can avoid emotional trading decisions fueled by anger and frustration. Remember that consistent, well-planned trades are the key to successful trading, not impulsive attempts to recoup losses. Well, there you have it, some of the main trading mistakes to avoid. Everyone has different strengths and weaknesses, so the challenges that you'll face will likely differ slightly to others. But hopefully this video helped you better understand the potential trading problems and the steps that you need to take to address them. If this video helped you out, leave us a like and subscribe for more videos in the future like this one, and I'll see you in the next video. Bye.